So no blue shirts this week, but my shirt is not meant to represent that I am waving the white flag. But this commentary is about those who might be giving up on their process just a bit too soon in this market cycle. Stay tuned. So what is the point of this week's commentary? The point is this. Range-bound market, we've been talking about this for some time, and within range-bound markets, people try to either get lured into trying to trade the range, or they get frustrated by that range and they try to add risk to their portfolios to manufacture returns or come up with some new thesis, theory, process midstream. Conclusion, that doesn't end well. Don't do it. We've been telling you for some time this was going to be a range-bound market. Stay patient. Patience, again, being the virtue above all virtues that can lead to long-term investing success. We've told you not to freak out by all the things that have been leading to increased volatility within that range, i.e. in March. We told you don't let this whole yield curve inversion freak you out. It was March 22nd. Went back and looked at it, that the Fed was likely to lower short-term rates and bring that back into alignment. But in any case, all the central bank intervention was making that, again, historically useful data point perhaps far less useful today. And then in May, in the midst of the trade crisis and one of the worst monthly performances in quite some time, we told you, there's hope. There's hope for things to bounce back a little bit, and the Fed was likely to be one of those catalysts. And thank you, Jerome Powell. He comes in to make us look good. I share all of that, again, not to talk about our ability to predict the future. Again, as I said last week, to encourage people to try to trade any of that. The point is, again, it's never as good or as bad as one thinks. You've got to think past the headline, and that's what we hope to do and hope to have done in those commentaries with you, is take that headline and unpack it. And so, again, coming back to where I started today, I want to talk again about where we're at, sticking to a process, and maybe share some anecdotal stories. So I'll share one from early in my career. One of the first firms I worked at, I can remember distinctly, it was the dot-com era. We were in a relatively range-bound market over the summer that I was working at this place. And the company, as I recall, was Progressive Software. And they thought they had found a range and that you could just trade that range, buy it here, sell here. And they were literally doing this in client accounts. Here's how it ended. People got hurt. And what I took away from that is, in that whole dot-com era, again, I began in this business in 95, and again, thought myself, hey, this is easy. You just buy stuff and it goes up. Watch this range bound. That was another, obviously, cautionary tale. But for both of them, the point being, investing is not an easy game. It is not something to be taken lightly, and it is something that can hurt people. I've seen it wreck marriages, I've seen it wreck lives, I've seen it wreck companies, and helping be better at that, something that drove me to want to enter into this profession. Howard Marks, he's worth $2 billion. Put it this way, here's part of the trade-off with diversification. You need to be diversified enough to survive bad times or bad luck, so that skill and a good process can have the chance to pay off over the long term. That's it. That's the truth. That's what we want you to stick with. And we get it. We get it. What's worked lately has been buying more of what's ever hot. It's called momentum trading. Again, it's extremely dangerous. It can work out for a long time. As you saw in that dot-com era, people's accounts swelled to huge values only to come crashing down and take a decade to even hint at coming back. That's what we're hoping to help you avoid. So where are we headed to from here? Tim, if you're telling me this frustrating range-bound market, where do we go to from here? What should we be emotionally prepared for so it doesn't surprise us moving forward? So just when it seems like maybe it can't get any better, the Fed's pivoted dovish. Trump and Xi are supposed to sit down at the G20 summit next week and give us the trade breakthrough, and then we'll just be off to the races. And that would be nice. I'll have to point out, we've got some serious macroeconomic data headwinds over the next 2 quarters. Not only is data slowing in general across the globe, but in a world that's always looking at things on a relative year-over-year basis, we are heading into the 2 steepest quarters, perhaps one of the peaks of the recent cycle in the next 2 quarters for both geopolitical data, GDP growth, corporate earnings, and that is going to be a serious headwind for equities moving forward. Could Trump's trade tweets, say that quick 6 times, push us higher? Could the Fed get even more dovish? Possibly. Do I think that's a process-driven way to approach investing? I don't. And so I would argue that investors should be a little bit more cautious with capital, new capital at this time. Doesn't mean you got to, of course, abandon the pool, but don't chase at this point in the market. Longer term, new theory, hang on to it. As we get into 2020, not only do the comps get easier, again, for earnings and for growth, both globally and domestically, but deflation, the thing that the Fed is starting to finally talk about, is here to stay, in our opinion. You've got technology advancements, making things more efficient, pushing prices down. You've got an aging demographic pushing prices down. You have global competition pushing prices down. What does that mean? It means central banks stay accommodative. It means yields likely stay low. And if yields stay low, then equities look relatively attractive and will have higher valuations on a relative basis. And right now you've got a corporate earnings yield about 5.75, give or take, depending on the day. You've got a 10-year yield at 2%. Historically, long-term, again, if corporate earnings are higher than that 10-year, that represents attractive valuations. And so again, that's something to keep in mind as we move forward. If those yields stay low, it gives stocks over time a potential runway to again rebound from what could be some near-term headwinds. So that's what we want you to prep for. Just like everything we talked about from previous commentaries, we're not telling you to trade it, we're telling you to know it. Our process here is already built to get both through the headwinds as well as to take advantage of the tailwinds. And whoever you're working with or whatever process you hope to employ, again, stick with it, stay disciplined, stay patient. Thanks so much.